All right, welcome back for this second session on inflation dynamics and inflation expectations. My name is Sylvain Leduc. I'm Director of Research at the San Francisco Fed. So, of course, this topic of inflation expectation and inflation dynamics, that is basically at the center of what we do here in central banks and at the Fed, and was a crucial ingredient of the 2020 framework review. And so I'm delighted to have two great speakers with us today. We have Yuri Gorodnichenko, who's Quantage Presidential Chair in Economics at UC Berkeley, a good friend of the San Francisco Fed. I think we're a neighbor on top of that. And also Mark Gertler will be our discussant. He's Lucy Mose's professor of economics at NYU, well known for his work in macro and finance. We're delighted to have you here, Mark. And so I'll turn it over to you right away. You have 30 minutes, Yuri.
All right. Well, thanks very much for inviting us to write a paper for this very important conference. We had a very simple set of instructions, just summarize what you know about inflation expectations and give us some ideas about how we can use this knowledge for policy making. That's what we try to do here. Fortunately for this audience, I don't have to spend a lot of time explaining why we care about anchored inflation expectations, right? So a lot of what we do in this room and in other central banks is about achieving better macroeconomic outcomes, macroeconomic stability, and we know we need to have anchored inflation expectations to deliver this objective. However, macroeconomic stability is not something we have been blessed with in the last 5 years, right? So we had a pandemic, we had an inflation surge, we had another invasion, Russian invasion of Ukraine, we had all sorts of trade frictions. We saw a lot of chaos and volatility, right? That's something we don't really want to see in the economy, and we want to avoid this kind of situations. But from the perspective of the economics research, it's actually a great opportunity for us, because when you have so much volatility, so much variation, you can see things clearly, something you would never be able to do in a stable macroeconomic environment. And so one thing we wanted to do in this project is also try to utilize this volatility, this natural experiment, to learn something about how people form and use inflation expectations and what we as policymakers can do about that. Now, we have many lessons from this exercise, but I'll focus on the main one, which is we don't believe that inflation expectations are anchored. They were not anchored before the surge, they were not anchored during the surge, obviously, and even now they're not particularly anchored, right? So what you see in the US and in other advanced economies is that inflation expectations are very volatile. They don't seem to be very anchored. In fact, what you see is a clear pattern, which we call a cycle of selective inattention. And in a nutshell, the idea is this. When inflation is low and stable, people don't have strong incentives to pay attention to inflation. It just doesn't matter if inflation is 1.9 or 2.1%. Right? So people are not paying attention to that. As a result, they have very diffuse beliefs about where inflation is, where it's going. And it's going to be very easy then to change their beliefs from low numbers to high numbers, just because when they look at prices of the goods they buy often, like the price of eggs, price of milk, price of gasoline. These are very volatile prices, and as a result, their expectations may be also very volatile. Now, at the same time, when you look at periods when inflation was high, we know people have very strong incentives to pay attention to inflation. But what they see is kind of very discouraging for them. They see that inflation is very high. It is going to be very different from the inflation target. They sort of learn that the central bank is failing. And as a result, they're also going to have unanchored inflation expectations. So it seems like no matter what you do, you're going to end up with unanchored inflation expectations. It's not a very pleasant situation. And obviously, it has many, many implications in terms of what we should be thinking about the sources of the business cycle, sources of inflation, and what we can do as policymakers to anchor inflation expectations. So for example, if we take unanchored inflation expectations as a starting point and try to understand why we had a surge in inflation in the US and in many, many other countries, our conclusion is going to be that we were just unlucky. We had a period of elevated energy prices, all sorts of disruptions, and if you combine this with unanchored inflation expectations, you can easily generate a big surge in inflation. On the policy side, we did a few experiments with people participating in our surveys, trying to understand what kind of buttons we can push to make inflation expectations more anchored for an average American or for an average European. And we found that varying policy framework from inflation targeting to price level targeting or some intermediate case is not going to be enough to anchor inflation expectations in itself. You have to dig deeper. And what we argue we need to do is to bring inflation as quickly as possible to the target when inflation is high, to make sure that people don't learn their own lesson, that the central bank is somehow failing them. And once you achieve this objective, you should be working very hard to penetrate this wall of inattention that people typically have in low inflation environments and make sure that they learn that inflation is low and stable most of the time. It just sometimes we have unlucky situations and inflation can be out of control. Now, in what follows, I'll try to elaborate on each of these points and hopefully convince you that what we do makes sense. But before I do this, I wanted to make sure that everybody is on the same page about what kind of measure of inflation expectations we should be looking at. Right, so there was already a discussion earlier this morning about is this SPF, short-term, long-term, and it is a very important question. We have expectations from different agents at different horizons. For example, you look at firms and you very quickly realize that some decisions are going to depend on their long-term inflation expectations. If you build a factory or something like that, long-term, obviously you have to be thinking about long-term expectations. But for many, many, many decisions that firms are making, it is really short-term inflation expectations that are most important. Think about pricing. If you set your price and you know you're going to stick to it for another 6 months, maybe 12 months, you don't care about where inflation is going to be in 5 years or 10 years. What is important for you is where inflation is going to be over the next 6 or 12 months. After this, you can fully re-optimize. You don't have to worry too much about where inflation is going to be. The same story applies to consumers. Many decisions depend on short-term inflation expectations. Many decisions depend on long-term inflation expectations. But I would say the vast majority of what people do in their daily lives is a function of their short-term inflation expectations. Financial markets, another big player in the economy. Here I think it's a more balanced situation in the sense that we should care about long-term and short-term inflation expectations. Pension funds, they definitely care about long-term inflation expectations. Short-term traders, they just care about where inflation is going to be next instant, next week, next month, and so on. We also have professional forecasters, maybe the most overstudied group in the field of economics. They give us very precise answers. We love to study them. But when you look at their role in the economy, it's not clear what they do exactly. Right? Their consumption choices are not reflected in GDP numbers. Their inflation decisions are very small. They can inform us about where the economy is. They can signal to us how credible the target of the Fed is. But fundamentally, they are not the right people for us to look at because they account for such a small fraction of what is happening in the economy. So the main point I want to give you with this table is that there are many, many agents out there. If you care about the real side of the economy, you have to be thinking about firms, consumers, and financial markets, of course. And these guys are going to be behaving very differently, as I'll explain in a moment. But we shouldn't discount firms and consumers just because they're crazy or have some unusual expectations. They're making very important decisions based on those expectations. We should take it seriously. Now, going back to the point, the main lesson about unanchored inflation expectations. There are different ways how you can measure how anchored inflation expectations are. This is some metrics. There are different ways to establish whether expectations are anchored or not. I'm going to focus on these 5. You go to the data, and very quickly you realize that none of these conditions is satisfied in the data. Inflation expectations are very different from the target. You see a lot of disagreement, huge revisions from one survey wave to another. All of this is signaling to us that inflation expectations are not anchored. Now, how big the departure you see in the data from anchoredness? To appreciate the difference, I think it's very useful to look at the dynamics of inflation expectations during the surge. This time series here is headline CPI inflation in the US. We see a massive increase. We almost hit double digits. Then inflation quickly collapses, but it remains elevated. Okay? Now, we want to study how different agents revise their inflation expectations during this period. I'm going to start with the gold standard, which is inflation expectations of the FOMC members. If these expectations are unanchored, we are doomed, right? So we want to make sure that, this group of people believes that they can deliver 2% inflation. And you can see that most of the time there is a success, right? So inflation expectations are anchored at 2%. But in 2022, there was a fairly significant departure from 2% inflation target, right? We had almost 2 percentage point gap, so to say. Anyway, so this is going to give us a benchmark for thinking on what is anchored inflation expectations. You look at first people who are probably some of the most informed agents in the economy: professional forecasters, financial markets, inflation traders, and I want to thank Julia Coronado and her colleagues for sharing data with us. It was super informative. When you look at this group of people, some of the most informed agents in the economy, and compare them to FOMC members, you very quickly realize that they're very, very similar. Everybody agrees that inflation is, roughly 2% in the long run or short run, but there are some deviations from one month to another. So this is good news for us. These expectations are relatively anchored. When you look at expectations of, for example, households using the Michigan survey of consumers, you see a very different picture, a massive increase in inflation expectations. Then inflation is collapsing, but inflation expectations are not going down fast or fast enough for us, right? And in fact, if you look at recent readings of inflation expectations from the survey, they are growing up very rapidly, and this is not something we should take a lot of comfort in. And obviously, this is not consistent with anchored inflation expectations. You see big departures there. Firms. We don't have long time series for firms, but now there is a survey run by the Cleveland Fed, which surveys managers of US companies, asking them to tell us about their inflation expectations. Their expectations are very similar to households' inflation expectations during this period. Massive increase, some decrease after the end of the surge, but they remain elevated. And the most recent readings of the survey suggest to us that they still have very high inflation expectations, and these expectations may be increasing. So we have different agents in the economy. Some agents are more anchored than others, but when you think about households and firms, we think it is a wrong starting point to think that these expectations are anchored. They look very, very unanchored to us. Now, we can do another test. We can say, okay, forget about short-term expectations because they're volatile, they change for all sorts of reasons. Let's focus on long run, 5-year ahead inflation expectations. And again, I'm going to use the gold standard of SEP to kind of set the benchmark here. You see expectations are very close to 2%. This is how anchored inflation expectations should look like. This is the expectations from some of the more informed agents in the economy. And there is a lot of kind of similarity there. But at the same time, you see that there are cracks in this, agreement we saw before in short-term inflation expectations. Sometimes the difference between financial markets and FOMC members is going to be as big as 1 percentage point. The most recent data suggests to us that they expect at least half percentage point higher inflation over the next 5 years. It's not the end of the world, but it's obviously not a comfortable situation. That for some reason, these people think inflation will be higher than FOMC members. Now, households and firms. Here you see, again, a very different picture, a massive increase in long-term inflation expectations for households and firms. And again, the most recent readings of this data suggest to us that we have a serious problem on our hands, that these expectations are very, very different from being anchored. Now, one kind of line of thought we can have to deal with this situation is to say, well, there is all this noise and biases and other issues in survey data. Maybe we shouldn't take it too seriously. And obviously, there is a lot of noise and biases in the surveys, but we shouldn't discount this as being pure noise or anything like this. Kind of one way how we can see this is to look at this figure, which shows the time series of the average price of gasoline in the US and 1 year ahead inflation expectations in the US. And we call it internally with Oli an iron law of inflation expectations. Right? If you want to know what is the level of inflation expectations in the US, you just need to look at the price of gasoline. This is very striking, right? You see a very strong correlation, not only at low frequencies, but also high frequencies. And you might say, this is crazy. We're comparing levels of prices with changes of prices. It should not, be there. But if you're an average person who is not very kind of versed in economics and you have only limited capacity to collect and process information, it makes total sense for you to look at the price of gasoline because we know historically it's correlated with the level of inflation. It's very easy to observe. It's a homogeneous good, very easy to compare across time and space. And so it's not crazy for you to use this price, this specific price, to form your inflation expectations. So it's telling us that inflation expectations are actually related to some type of fundamental force in the economy. People are responding to incoming information. There is another set of tests you can do. One was suggested by Ben Bernanke, that inflation expectations should be insensitive to incoming information. He didn't suggest a specific test, but we can have different sort of implementations of this test. Here is one of them. You regress in a cross-section long-term inflation expectations on short-term inflation expectations. And if your expectations are truly anchored, it means we should see zero correlation between these two objects, because where inflation is today should have no bearing about where inflation is going to be in 5 years, because everybody should believe that inflation is going to be 2%, close to the target. Now, you can run these regressions, and you can see very quickly that, at least in the most recent readings of the data, the correlation between short-term and long-term inflation expectations is very high. Again, this is not consistent with anchored inflation expectations. You can do other versions of this test. For example, you have a transitory shock. It should not affect long-term inflation expectations for agents in the economy, because they should be anchored. One of the shocks will be monetary policy shock. You can do this with financial markets, and you will find that even this transitory shock can have a significant impact on long-term inflation expectations. Again, this is not consistent with anchored inflation expectations. Now, final test of how anchored inflation expectations are. This figure here shows the time series of actual inflation in the 1970s and inflation expectations from the Michigan Survey of Consumers for the same period. Right? You see a massive increase in inflation, massive increase in inflation expectations. We say it's not surprising what happened then, because this is what happens when you have unanchored inflation expectations. This is the narrative we have in our textbooks. Right? It kind of illustrates the dangers of unanchored inflation expectations. You will have a situation where inflation and inflation expectations feed on each other. Right? You expect high inflation, you end up with high inflation. You see high inflation, you have even higher inflation expectations. That's the narrative we have in our textbooks and research papers. Now, this figure here is the most recent episode. Again, a massive increase in inflation, a massive increase in inflation expectations, but we have a very different popular narrative out there, which is saying we actually have anchored inflation expectations. The reason why inflation fell so quickly is because inflation expectations are anchored. But when you compare these two figures, it's really hard to escape thinking that, maybe we don't have, that much of a difference between these two episodes. And then we have to make a decision which narrative is probably more appropriate. We think the 1970s narrative is right. But, we need to do obviously more research to confirm this. One thing I also wanted to mention in this context is when you look at the 70s, specifically this first surge in inflation in the 1970s, we know once you have unanchored inflation expectations, if you have a one-time shock from supply side or demand side, it doesn't really matter. One-time shock, a level shock, we can create a very high and sustained level of inflation for quite some time. Right? So this means that once you have unanchored inflation expectations, you can't really ignore one-time shocks. If you have unanchored inflation expectations, you have a spark, right? Something that moves prices, and you can get fired very, very quickly. So we want to avoid situations where you can have one-time shocks. And in the current conditions, who knows what it's going to be? It may be a change in energy prices, it may be tariffs, whatever it may be. We're in a dangerous state if we believe these two figures. Now, to summarize, we have different expectations out there, different horizons. Our main conclusion is that inflation expectations look very unanchored to us, especially for households and firms. For other agents, there may be different degrees. But for many, many things we do in macroeconomics, we should take unanchored inflation expectations seriously as a possibility. Now, obviously, people don't have in their DNA anything that will tell them that they have to have unanchored inflation expectations. We know people respond to incentives, they change their beliefs with the macroeconomic environment, and obviously this is going to give us hope that we can do something about this unanchoredness in inflation expectations. Right? Now, how do we know that people can respond to this? Here is one kind of test you can do in the data to see it clearly, and this is based on a randomized controlled trial where a random subset of people is told something about inflation, a past inflation number or an inflation target or a forecast for inflation. And you can then compare their beliefs to the control group, people who don't receive this information. And if you see big differences between treatment and control, you know people were not paying attention before to the statistic you provided to them, right? So it's a very simple test. How does this work in practice? This is from an experiment Oli Corbion, Michael Weber, and I did in 2018 when inflation was a very boring subject. Nobody cared about inflation. And this figure is for the control group. We have prior expectations, posterior expectations. These people, remember, are not treated with information. They should have no reason to change their beliefs. The relationship here should be very close to a 45-degree line. We don't have exactly 45-degree line, but we are very close to it. Now, what happens when you tell people about either inflation target or inflation forecast or post-inflation? You see massive revision in the beliefs that these people have. Posteriors are very close to the signal you provide to them. It's telling us that people didn't pay attention to these statistics before. They are rational. They respond to these signals. They move their beliefs towards the signals. It's consistent with Bayesian learning. Right? So when you have a big change in the slope, it's telling you people are not paying attention to this information. If the change in the slope is very small, it means we are not surprising these people with this information. They should know these numbers. And in principle, we can repeat this experiment over and over in different times in different countries and see how this change in the slope is varying with the macroeconomic environment. That's what we did in the US using Nielsen home scan panel, a huge cross-section of households. And in a nutshell, what you see in this figure is that when inflation is low and stable, people are not paying attention. When inflation is high and volatile, people paying a lot of attention. So we have a change with the macroeconomic environment. It's telling us also that if policymakers do something differently, people may change the way in which they form inflation expectations. Now, one final figure I want to mention in this context is that before, again, in 2018, people struggled with answering a basic question. What is the inflation target of the Fed? What is your perception? You know, people would say, 20% or just say, I don't know. Very few people would say 2%. When you ask another cross-section of people recently, in April 2025, many more people now know the inflation target. They know it's 2%. But they continue to forecast that inflation is going to be 5% or 10%. Right? So this is a very dangerous sign for us. Even though they understand that the Fed wants to achieve 2%, they are not believing that number. They think inflation is going to be much higher. So in a way, it was a lesson. We told people that inflation is 2%. That's the target. But it was a very expensive lesson. And in fact, if you ask people how much consumption you would sacrifice to ensure price stability, they would say in the US something like 5 to 6%. And that's consistent with the numbers Eric showed earlier this morning when he said that the wage gap relative to the trend is something like 5%. So it was a very expensive lesson. People hate inflation. We know this now for sure. They learned the inflation target, but they also learned that inflation is very different from the inflation target. It's teaching them a very wrong lesson, so to say. Now, what do you do when you have something like this? Obviously, you need to communicate to the public at the times when inflation is low and stable. This is going to be challenging because people are so inattentive. But we know in principle we can penetrate through this wall of inattention. We can see this in our experiments. In the high inflation environment, it's obviously very different. You have to focus on bringing inflation down as quickly as possible to the target to make sure that people learn the right lesson, that the central bank can deliver the inflation target, instead of learning that the central bank may be failing. Now, if inflation expectations are anchored, what do we do with this? Right? We can have some normative exercises, some positive exercises. And I'm going to start with a positive exercise. Phillips curve, right? We can use this object to learn something about how people think about inflation and how this translates into actual inflation. You know, one basic question when you try to do this, what kind of expectations we should use? Theory is telling us it should be inflation expectations from firms, and this should be short-term inflation expectations. Okay, we can check if this is true. We'll use Michigan Survey Consumers as a proxy for firms' inflation expectations. Run a horse race of Michigan versus SPF, and very quickly you will find that it is the Michigan Survey Consumers that has most predictive power in this context. You can also look at different horizons in the Michigan served consumers. And again, you very quickly realize long-term expectations are much less important than short-term inflation expectations in explaining what we see in the data. Cost push shocks, usually we have hard time explaining what it is because it's a residual. We say it's a markup shock, and so it's very hard to know what it is exactly. But for this period, we have a very clear story what that was. Right? So we know it was the Russian invasion of Ukraine as one of the forces that drove energy prices to really high levels. And once you increase the prices of natural gas, it means we're going to have high prices for fertilizer, and then it means high prices for food. Okay, so we can have a very direct channel there. We also know that during the COVID crisis, there was a massive change in the composition of demand. Maybe not so much in the level of demand, but composition for sure. And again, we know this is not related to many things that were happening in the world. The final thing I want to mention here is when we work with this Phillips curve, we can rearrange things a little bit to make it easier to visualize everything. And so we'll move inflation expectations to the left-hand side and work with inflation gap versus unemployment gap and see what happens there. Now, this is a situation where you take incurred inflation expectations seriously. Right? So here we just assume that inflation expectations are perfectly anchored at 2%. This would roughly correspond to a situation where we use long-term inflation expectations from the SPF. And when you use this as a measure to construct inflation gap, you see that during the COVID crisis, we had, at least in early stages, movements more or less along the Phillips curve. But then sometime in 2021, we start to develop a massive deviation. And it keeps increasing in 2022. And then we have a vertical movement in the space. Right, so we can be very creative here and say, oh, this is a linear Phillips curve, or maybe we should use alternative measures of slacks. And this will be very reasonable explanations, but you don't have to do it. If you can take Michigan served consumers and say this is the expectations that should apply to the Phillips curve and use that to construct the inflation gap, you see that the deviations from the historical relationship are going to be much smaller. And when you adjust this gap for these cost push shocks, the price of natural gas, the changes, the bottlenecks in the shipping industry, there is very little unexplained variation. Right? So it's basically telling us that we can explain what was happening in this episode just by appealing to energy price shocks, other supply side shocks, and unincurred inflation expectations. If you have this too, you don't have to go very far. Now, in the interest of time, I will mention just a few more things. We can do a natural experiment here and say, some countries worked very hard to make sure that their energy prices are not going up. For example, you look at Latin America, Bolivia made a conscious decision to subsidize and control energy prices. What we see in this data is that relative to its peers, Bolivia didn't really have a lot of inflation at the peak of the crisis. Right? Eventually, the subsidies were extremely expensive. They had to print money to monetize these fiscal deficits. But in this critical juncture in 2021, 2022, they actually didn't experience a ton of inflation. Taiwan, a similar story. They really subsidize and control energy prices, much less change in inflation. In Europe, it's a little harder to find a comparable story, but probably Switzerland is as close as you can come, where you can see that there, in this country, they rely a lot more on hydropower and nuclear power, and so as a result, they are much less exposed to changes in the prices of natural gas in Europe after the Russian invasion. So, it's kind of a striking story then if you look at this data. It basically tells us that we had a situation with bad luck followed by good luck. We had this massive increase in inflation and inflation expectations because we had a very bad supply side shock and we had unanchored inflation expectations, but then we had a massive reversal just because the energy prices collapsed so quickly. This means central banks should not be blamed for the rise of the inflation, but they should also not take too much credit for the rapid disinflation. Now, what do we do with this? Okay, how we can make sure that something like this does not happen again? We do a bunch of surveys to see what people would expect for inflation if we offer them alternative policy frameworks. Suppose inflation is going to be, controlled through inflation targeting or price level targeting or some intermediate case. What would be your inflation expectations? In a nutshell, we see very little difference across these frameworks. So it's telling us, this is in itself is not going to be enough to anchor inflation expectations. Now, of course, the data is more nuanced and you can see different stories there. For example, if you ask people, what do you think the Fed is doing in response to a one-time increase in the level of prices? Most people will say the Fed is going to do nothing. They're going to look through this, okay? When you ask people, what do you think the Fed should be doing? Many more people would say, we actually want to have some price correction. We want to have a reversal towards the initial level of prices. So maybe there is some demand out there for some form of price level targeting or average inflation targeting, but people probably can't really formulate it in terms of policy frameworks. You have to change the communication with them. Now, so if you can't really, anchor inflation expectations just by having this variation in IT versus PLT, then what can you do? Our story is that when inflation is high, try to bring inflation as quickly as possible to the target. When inflation is low, this is your opportunity to make sure that people learn that the vast majority of times, central banks are extremely successful in delivering low and stable inflation. This is our window of opportunity there. Now, we know it's too late to do something like this, but nonetheless, we still have some very important questions. What do you do with this now? And one important question you often hear in press conferences and in general discussion is, what the Fed is going to do. What's the trade-off between inflation and unemployment? Now, the science of monetary policy, I'm very glad Mark is our discussant, is very clear on this. You anchor inflation expectations and you're going to improve the trade-off between inflation and unemployment. This is what we want to do. However, this is not the luxury we have today, we think. We don't have anchored inflation expectations. What do you do with this? We have some ideas from the 1970s. Paul Volcker, one of his first speeches as the chair of the Fed, he's saying, once you have unanchored inflation expectations, there is really no trade-off. You have to focus on bringing inflation to low numbers. That's your main objective. You don't worry about anything else. And then in later speeches, he developed this point and said, everybody understands what we need to do, but the key question is, are we going to do it? Are we going to be persistent in our attempts to bring inflation down? And he said, unqualified yes. It's kind of striking that he had a separate line in this speech saying, and I'm not going to have any caveats to that answer. So to summarize, I know I'm out of time. We all want to have anchored inflation expectations. When we started this project, we wanted to find anchored inflation expectations in the data. However, we don't see a lot of evidence out there, at least in surveys, suggesting to us that you have anchored inflation expectations, especially for households and firms. And if we ignore this fact, we may be in all sorts of problems. What we can do if we take it seriously, one thing we can do is to break this cycle of selective inattention, right? Try to communicate to people when inflation is low and stable. I know this is hard, it's difficult, but it can be done. We also need to make sure that we focus on inflation expectations that are most important for most agents. We don't have to look at professional forecasters. They don't matter for anything. We have to look at households and firms and financial markets. This is our objective. And then more, I think, importantly, in current conditions, we should not be thinking that one-time shocks are not going to ignite a high and persistent inflation. If you have unanchored inflation expectations, we have to be very aggressive in responding to these one-time shocks. Thank you.
All right. Thank you, Yuri, for a provocative presentation, and Mark will give the rebuttal, I guess.
Who knows? But I am going to try and be a little more upbeat. Let me, first of all, say I'm a great admirer of Yuri's work on expectations, and so I really appreciate the opportunity to read and discuss this paper. Now, at the core, what the authors do is estimate a Phillips curve, which relates inflation to the unemployment gap plus expected future inflation. And the distinguishing feature is they use survey measures of expected inflation to proxy for actual inflation. And four main results. First of all, short-term expectations matter more than long-term. Second, households perform better in this equation than do firms, and professional forecasters are at the bottom. Third, household and firm expectations are unanchored. And fourth, watch out, households are signaling inflation. So nothing controversial here. All right, now to frame my discussion, I'd first like to describe the conventional wisdom on short versus long run expectations and inflation, and also what anchoring can do. So what I want to do is modify the Phillips curve I just showed you to allow for time-varying trend inflation, which I'm going to call pi bar t. And I'm going to call x hat cyclical unemployment. That's the difference between unemployment and long-term unemployment. Now, the main difference between this Phillips curve and the one on the first slide is now expectations are a convex combination of the short run and this long run trend. But this discount factor beta is close to unity. So it's correct that the short-term forecasts have more impact in the structural form than does the long-term forecast. However, the short-term, or inflation has both a cyclical and a trend component, so the forecast of the short-term is going to depend upon what the trend is. And we can illustrate by assuming that the output gap follows a first-order autoregressive process, solve out, and what do you get? You get, in the reduced form, inflation depends upon a set of shocks. There are demand shocks and supply shocks, plus trend inflation, okay? And where does the trend inflation come from? We think that comes from central bank credibility. So central bank loses credibility, trend inflation drifts up, actual inflation drifts up. Okay, what happens when we have anchored expectations? And here my definition, I think, is a little different from Uri. I think anchored refers to the trend, whether the trend is at target, because it's recognized the short run can differ from target. Now, to be credible, you can't differ for too long, like 3 to 4 years or something like that. But what's key is that it's the trend that's anchored. So bottom line is whether or not trend inflation expectations are anchored is going to affect both short-run inflation and the expectation of inflation, okay? Now, a common way to illustrate what anchoring can do is with this figure which plots the 10-year forecast of inflation by the Survey of Professional Forecasters against core inflation. It's from the late 70s to the present, and I divide the sample in half. And you see in the first half, long-term expectations are unanchored, and also the correlation is very close to unity, and that's just as the simple model would predict. Then over time, as the Fed establishes credibility through its actions, through communication, long-term expectations drift down near target, and also the correlation between inflation and long-run inflation weakens. Now, a main point of the paper is you shouldn't be looking at the forecasts of professional forecasters. You should look at, ideally, at firms. Firms aren't available for a long sample, so a reasonable proxy would be households. So here I do the same exercise, but I substitute the Michigan survey long-term expectations from the Survey of Professional Forecasters. Now, first of all, you do see a similar pattern. In the first half of the sample, long-term expectations are way up, and there's a pretty strong correlation with inflation. Over time, in the second half, long-term expectations drift down, and the correlation with inflation weakens. But two important differences. First of all, expectations don't go all the way, okay? So maybe the Michigan consumers aren't paying attention to Fed communication. Okay, they're at about 3.5% to 4% above the target. Now, a key point, which I want to return to later, they're also above actual inflation. They're not just only missing the target, they're missing actual inflation. The second difference is expectations take off in the second part when there's really no observable shock. So what's going on there? How does it matter? And I want to return to that later as well. Okay. Now, I want to take up the author's suggestion that you can formalize the degree of anchoring, I guess, with the Bernanke test. So I want to look at the pass-through of short-run expectations into long-run expectations. The coefficient of beta it measures pass-through, and the higher beta, the less successful is anchoring. Now, there's going to be some bias in this regression because long-term expectations, a shock that affects long-term expectations maybe affect the short run. So think of beta as an upper bound on pass-through, okay? But the key prediction is in the early part of the sample, beta should be high. When there was no anchoring, it should fall in the second part where there was anchoring. And that's what you see for both professionals and the households. Professional is the first part of the sample. The coefficient pass-through is about 0.8, drops to a little over 0.2 in the second part. Something similar with households, but it doesn't quite go all the way, okay? Well, as far as with professionals. Okay, now the authors estimate pass-through in the second half of the sample using a panel data approach. I use time series. There's pros and cons of both, but we get similar results, okay? So my estimate of pass-through for the Michigan households is the same as what the authors was. Now, one difference is they look at the 5-year forecast instead of the 10-year forecast, and they see high pass-through for the 5-year survey of professional forecasters. But I checked, and actually I do as well. So there's no controversy there. But there is kind of a puzzle. There's low pass-through on the 10-year forecast, but high pass-through on the 5-year forecast. So what could be going on? I think what's key is the Fed doesn't really target a single number like 2%. It targets a range. So it's content with inflation oscillating between 1.5% and 2.5%. So it'll tolerate very persistent behavior of inflation within that range. Inflation goes outside the range, they will act very regressively. So you have kind of a nonlinearity in behavior. What do I mean? Okay, so this figure on the left-hand side, I plot the 1, 5, and 10-year survey of professional forecasts over this period. The right side is the pass-through estimates, again, high for the 5-year, low for the 10-year. Now, you can see that pre-pandemic, the 10-year forecast is pretty steady. It drops about 20 basis points. But the 5-year and the 1-year move around a bit, but it's all within the target range. So, like I said, if the Fed doesn't care if inflation's 1.75% and it persists, it's just so long as it stays in the range. Then what happens in 2022, there's a potential loss of anchoring. Both the 1 and the 5-year jump well above the range. The 10-year jumps a little bit above the range as well. So what happens? We get very aggressive monetary policy. We're not quite back there, but we are closer, okay? Now, the central question, whose expectations matter? Okay, as you already said, they tried different forecasters. The forecasters that work best are the Michigan survey, a beta of 1.5, an R-squared of 0.7. Works better than the survey of professional forecasters, although you get a more reasonable estimate of beta, the R-squared is lower, okay? And also in a horse race, the Michigan consumers win. Now, issues. One, possible reverse causality. Here, the authors are totally open about it. They're estimating by OLS. So could household forecasts be more sensitive to current inflation? So as you already said, they're less sophisticated. They'll look backwards. They're not paying attention to Fed communication. They're just looking at what's out there in the news. Now, I want to really be fair about this because in Yuri's other work with more narrower data sets, he's very careful about exogeneity, okay? But it is an issue in the conclusions you draw here. That is, endogeneity and measurement error are going to create problems for the counterfactual. There's going to be an upward bias in the estimate of beta, and it kind of seems like there is here because the estimate of beta for households is 1.5, so more than 1-for-1 effect on inflation, and that could be endogeneity. Another question is large firms. Okay, I saw an interesting paper by Alvarez, Blazer, and co-authors that show that the 10 largest firms account for 41% of sales. If you look in manufacturing, the top 1% of firms account for 75% of sales. And you'd kind of think these firms aren't relying on the Michigan households, although it'd be really interesting if they were to figure out why. Okay, and that's something that I suggest looking into. Okay, let's dig a little bit deeper. So here I want to compare the 1 year ahead inflation forecast from the Michigan survey against actual CPI inflation. Michigan's the red, the dashed blue line is the CPI inflation. And then below, I'm putting the forecast errors from a year earlier, okay, the error in the year ahead forecast. And here, okay, first the bad news. If you look within the inflation period, okay, the forecast errors average about 2 to 3%. The Michigan forecasters are above by about 2 to 3%. And we think we do need a story of, if these are the price setters, okay, why is inflation low over this period? Now, maybe we can work that out, but I think that's the next step. Now, the good news, they catch the run-up. They catch the run-up for the 70s inflation. They catch the run-up for the recent inflation. Although if you look more carefully, they tend to under-forecast the run-up and then over-forecast inflation as inflation is coming down. And again, that's kind of suggestive of adaptive expectations. But here, it seems, the message seems to be if you pay attention to what's going on and not try to do some fancy forecast ahead of time, you do better. And that seems to be the case. Okay. But again, we want to get at the deeper issue of, are these Michigan forecasters, are they like canaries in the coal mine, or are they actually affecting price setting? And I think that would be a very interesting avenue for research. Now, the last point is, what's going on at the end of the sample, where there is this jump in inflation expectations. And it doesn't seem like gas prices are jumping or anything like that. It just seems like they're going up. So again, are they canaries in the coal mine, or are they affecting price setting? If they're affecting price setting, you'd kind of expect to see it in current inflation, and we don't yet. So what possibly could be going on? Oops, okay. All right, if you put in tariffs and inflation in Google Trend, it skyrockets just about the time that the Michigan consumers forecast done. So they're aggregating information. And so what this, let me be clear, this doesn't suggest you should ignore the Michigan consumers, okay? They may be providing useful information. But we need a little bit more to be convinced that they're actually involved in price setting, okay? Now, just as a benchmark, let's compare with the professional forecasters. I'm doing the same exercise, except now the red line is the year ahead inflation expectations of the surveyed professional forecasters. Once again, the forecast errors are in the bottom, and you can hear in between the two high inflation periods, they do pretty well. Okay, the mean looks to be 0 and the variance is lower, okay? But for the high inflation periods, they're bad, okay? So I agree we should not, for these periods of inflation surge, we should not rely exclusively on their forecasts, okay? How much time do I? Okay. All right, one other point. Now, if you buy the story that expectations are anchored, what is it that's causing inflation? Well, you need large shocks. And the point is, I think we had large shocks. The top panel plots CPI inflation, that's the lowest curve, against something meant to indicate demand and supply shocks. The first is consumption growth. This is total consumption growth, which did go up. The second is, the top one is global commodity prices, meant to be a supply shock. Now, the two shaded lines are two significant points. The first is where these shocks kind of hit their peak. And that was the time when CPI inflation took off, okay? The second shaded line is the Ukraine war, which gave another kind of dose to supply shocks, okay? So what could underlie these movements? Well, look at the bottom panel. Government transfer payments, okay, jumped way above the rise in consumption, and most micro estimates suggest there was about a 6-month lag before the transfer payments really hit. So you have both the demand stimulus and supply stimulus, okay? Then you see from the New York Fed index that the supply chain tightening continued. So I agree supply shocks were probably most important, but I think demand shocks had a role as well. So these two shocks, compared with short-run expectations of inflation, okay, might be able to explain what happened. By short run, taking into account how these shocks affect inflation, okay? All right, so bottom line, interesting and significant research, and my view, though, is it's important to keep long-term expectations anchored, but I totally agree that we need more work on whose expectations matter for price setting. And I think, and I know Yuri's done this in other work, will involve modeling how beliefs are formed in order to sort out causality. And finally, we need to figure out what's going on with the Michigan households.
All right, thank you, Mark. I'll make a wild guess and suggest that this is going to trigger a lot of questions. So, Neil Kashkari first.
Thanks for the provocative paper. Yuri, I would just offer one other source of data you might consider looking at, which I don't think you mentioned, are labor union agreements. During the COVID pandemic and the big inflation surge, we had a lot of roundtables at the Minneapolis Fed, I'm sure many of my colleagues did too, with labor unions to understand what their negotiations were, what they were asking for in their 3 to 5 year agreements. And I took some comfort from the fact that if you just did the math of what they were asking for, mostly they were asking for their members to catch up, and then assuming that they'd have lower, moderate wage growth in the future. You also look at cost of living adjustments in union contracts. In the 70s, almost all union contracts had them. They fell away by the 90s. I think as inflation expectations got anchored, to the extent that those start getting reintroduced and those are a priority again, that would be supportive of your thesis. Thank you.
Okay, let's go to Larry Myers. I get Chris Ursak after.
I loved Yuri's paper. Mark's comments were fabulous, so I'm going to have to absorb them, and I'd like to hear what Yuri thinks about it. Let me tell you why I loved Yuri's paper. Number one, I love the fact that he said, got my attention at the beginning, inflation expectations are unanchored, period. Okay, that's good, interesting. Second, I've never been able to, he said short-run expectations are more important than long-term expectations. I've thought so, but haven't been able to get that into empirical Phillips curves. You did. Now, you said the reason I didn't is I was looking at the wrong measures of inflation expectations. I was looking at professional forecasters and market-based. Okay, I'll take in stride your comments on professional forecasters, but that was important. Now, and the supply side shocks were more important. There's one thing I really disagree with you about. What you said, when inflation is high, the most important thing is that the Fed work aggressively to bring it down. I think that's inconsistent with other things you said in your paper. The Fed wasn't responsible for the surge in inflation. They could do nothing about it. It would come down on its own. So you've got to make a real distinction between demand and supply forces affecting inflation. In a sense, the Fed did what it should, nothing. And they shouldn't get blamed for it, and they shouldn't get credit when it comes down. Okay, my views.
Let's take one more from Chris Ursak here, and I'll let the authors and panelists to provide comment.
Well, thanks for a fascinating paper and a great discussion by Mark. So one of the more provocative messages on the monetary policy side is that households might prefer some form of price level targeting, where if you have a cost shock driving up inflation, the central bank would bring it back down and perhaps even induce deflation. So I was wondering if it might be the case, though, that households regard, just like they regard inflation as a shock, basically an adverse supply shock, that they like deflation, and that's what comes across in the behavioral studies, mainly because they like favorable supply shocks, and they don't understand the general equilibrium effects. So that if the central bank actually had to do this, it would drive up unemployment, it would generate the sort of debt deflation that was very familiar 100 years ago and tended to be loathed by the public. Thanks.
Okay, Yuri, Mark, comments?
Okay, I'll start by saying thanks to Mark for an excellent discussion. You know, as a student of his many papers, as I said, you know, we wanted to have inflation expectations to work in the data. They don't seem to be there. We obviously have many measurement questions and identification issues. This is one of the most challenging subjects out there in macroeconomics because expectations are so endogenous. And that's why we have randomized controlled trials to know for sure causally that inflation expectations are translated into actions from firms, from households. I must say it's a very expensive research agenda. We will welcome any funding we can receive from people in this room and otherwise. One question is, you know, what's happening with the Michigan survey of consumers? And, you know, historically we didn't have tariffs. It was not very visible. Obviously, as I said, people are very responsive to changes in the macroeconomic environment. And if they understand that tariffs are going to be translated into higher prices, it will be you know, stupid to ignore this information and not change their inflation expectations. And we see they are proactively responding to this. They accumulate you know, stocks of things which are going to be expensive in the future. We see that inventories were very high. So to me, this is a signal that this may be more like a canary rather than just some random aberration in the data. Firms versus households. I wish we had a long time series of firms' inflation expectations to know for sure what these guys are doing, especially for large firms. But you know, when you look at what captains of the business are talking about inflation, I think Michigan survey of consumers is not necessarily a bad starting point. For example, Elon Musk at the peak of inflation was saying that we see a lot of deflation in the data. I don't know which data he was looking at, but we didn't have a lot of deflation at the time. Some other questions. Labor unions. You know, that's a very useful piece of information, but we have only a small fraction of labor force covered by unions. As an example, in Berkeley, everybody has a labor union but faculty. So I don't know what we consensus view there. It's true we have some positive developments. We don't have COLA agreements as often as we used to have. It's, you know, it's good for us. But on the other hand, and echo what Aishigul and Eric were saying earlier, you look at the survey of consumer expectations from the New York Fed. They ask people to report their wage expectations and their inflation expectations. And the wage expectations didn't really go anywhere. It was one of the bigger lessons we have from this episode, that inflation expectations went through the roof, but the wage expectations didn't grow. And that's maybe because people have anchored inflation expectations, or maybe they don't expect their employers to respond to inflation in the first place, and the only thing people can do is basically switch jobs to keep up their purchasing power. Larry's question about you know, what do we want to do when inflation is high, especially if it's driven by supply side factors? You know, there is no simple solution there. Paul Volcker was saying, I don't care if it's oil prices or whatever, I'm going to focus on bringing prices down. So from his perspective, the source of business cycles of inflation was not terribly important. I should say, you know, in the surveys, people really want to have, you know, some correction after price shocks, right? So if prices go up, they want to have at least partial reversion in these price increases, and they don't care if it's supply or demand. And we should also know that in household surveys, when you ask people, where do you think inflation is coming from? The vast majority of people will say it's a supply side view, right? So from them, inflation is really bad for purchasing power, something they really hate. And this is also related to Chris's question. One thing I didn't have time to cover a lot is this, survey evidence we have in recent, months is when we ask people, what is your desired rate of inflation today? Very many people want to have a deflation, right? They want the level of prices to go to the pre-surge level. They probably don't internalize that this may mean a big recession. It may be very costly, but they try to signal this preference through other means. Right? So they go to the polls and they express, what they want to see among policymakers. And so even though these guys may be, doing, having some beliefs which may seem not well justified by what we see in the data, at some level it doesn't matter as long as they act on these beliefs, and we should take it seriously.
Okay, I've got Bill Dudley here, Joe Gagnon, Ben Bernanke.
I have a question for both Yuri and Mark about how the Fed fits into all this. You have a little bit of a sort of instability in sort of equilibrium. It's like if everyone thinks inflation expectations is well anchored, Fed's confidence about that, therefore the Fed doesn't have to do anything, versus if inflation expectations are unanchored, then obviously the Fed has to respond. But there's a risk if there's a risk that the Fed sort of decides that inflation expectations are anchored, don't have to do anything, which actually then feeds into inflation expectations itself. How do you feel like inflation expectations are influenced by what the Fed does or doesn't do? Because it seems to me like that's relevant to the conversation.
Can you just pass in next to you question?
Yes, Benoît Maujon from the BIS. I'd like to bring international perspective in terms of the frameworks and their impact on whether inflation expectations are anchored. So we look over the last 50 years or so, and there's been a lot of convergence across central banks in terms of their monetary policy frameworks, and inflation targeting has been adopted very widely, and typically when it's adopted, it's followed by better anchoring of inflation expectations, at least of professional forecasters, people who do not matter at all, but maybe if they influence the large firms, they express themselves in the press, it still matters. So, I mean, in the data that was showed in the excellent presentation and discussion, it's not the case that households, they're spot on at 2%, but there are long instances where, it's flat, as is inflation. And then if you look at this international evidence, inflation is much more stable across countries in the last 20 years than it was in the previous 30 years, and that's very clear. And even the recent inflation episode, which had an impact on inflation, and inflation rose in a number of countries, it's also the case that it came down relatively rapidly and with a soft landing. So, it seems like the inflation targeting framework from this standpoint has delivered. And so, yeah, it's not perfectly anchored, but I wonder whether in the description that you did, Yuri, there's not a half-empty bias, which is very useful for the discussion, but maybe I take it more as a half-full glass perspective.
Yeah, Joe, and then Ben.
Thank you. This is more of an recent empirical observation than a question, but it supports Yuri's point, which is if you look at across countries where inflation rose more under COVID, so which countries had a higher increase in inflation under COVID, and it's true for advanced and developing economies. What explains that? Well, there's one variable that explains more than any other by a lot, and it's very robust. And that variable is where inflation was 10 to 20 years before COVID. It seems that people, when COVID hit, people who had a memory of high inflation in their past were much quicker to demand higher wages and prices. And this is also true for bond yields. And if you didn't have an experience of high inflation, you didn't. And it's true in the negative side too, whereas the smallest increase in inflation under COVID was in Japan, which had deflation. So this does raise the concern that having just primed people with a few years of high inflation, they may be more sensitized going forward.
Nice paper, Yuri. Nice line of work. Good discussion. If consumer expectations either cause inflation or even just are a better signal of inflation, then you seem to have discovered a permanent and large market inefficiency, because market measures of inflation, like break-evens, for example, are quite different from the consumer index. So I was just wondering if you have made any appropriate investments.
I guess you have to answer that. Okay, so I'll take some time to answer, and then we'll take another
Okay.
round after.
All right, I'll respond to Bill's question about how the Fed could make use of expectations. And I think back to the figure I showed where during the pandemic, survey of SPF forecasts were within target until 2022, where they all jumped outside the target. And that, I would take that as a serious sign that you may be losing anchoring. And so the appropriate response is very aggressive tightening to get back within target. I mean, the SPF is sort of the Fed's most loyal base. And if you're losing them, you need to take action.
I'll start with Ben's question about property investment. At a recent conference, I was approached by an investment banker, and he was asking me, how can we use the evidence to make money? And I gave him free advice. I said, look, we see a lot of polarization in the Michigan survey of consumers. People who are more conservative believe inflation is going to be low. If you're more liberal, you're going to expect a lot more inflation. So when you go to Texas, you should see a consumption boom, and if you go to California, you should see a depression. And so if you want to invest in companies, you should invest in companies in Texas, not in California. I give him this advice on the condition that we will talk again in a year, and he'll tell me how much money he made from that advice. So I don't know, we'll see. To Joe's point about, people now having, sort of a very sensitive attitude towards inflation, I think it's very much there in the data. We know from previous research that we have scaring effects from this, traumatic experiences. And even now, when you look at the Michigan survey of consumers, there was a decrease in 2023, 2024, but we didn't go all the way down to where they were. And this is one of the points we try to emphasize in our analysis, that once you have a situation where everybody is so sensitive to price shocks, it is very easy to move actual inflation just because everybody expects it to happen. And so then firms can raise prices just because they can. They don't have to justify anything because consumers are expecting these prices to increase. Benoit, you want to see half full glass. I agree with you. I think the purpose of this conference is to have a debate, so we wanted to have a half-empty glass. But also I should say that we have a lot of survey evidence, and we can have different empirical approaches to study the data. You can certainly tweak and torture the data to make it look anchored. Right. You can work with medians, truncated means, all sorts of things to kind of minimize variation in the data, and then you can conclude that inflation expectations are going to be anchored. My favorite example is the Reserve Bank of New Zealand. They used to run they still run a survey of households, and before they record your response, they have two questions for you. One is, if they ask you, do you know what inflation is? If you say no, then they hang up. If then you go to the second question and they ask you what's your inflation expectations, and you say more than 10%, they're going to raise you from the survey too. And maybe in the olden days it would be a sensible strategy when you draw people with extreme views. But now it's very hard to make a case that somebody expecting more than 10% inflation is a crazy person, right? And so the range of possible is much bigger, and we have to look at means rather than medians because the right tail is so active. Going back to a question about what do we do with this, there are obviously better people to talk about this. But Paul Volcker is very clear what we should be doing. We should be very aggressive to re-anchor inflation expectations, improve our trade-offs, and then we can work after that on other issues.
Julia Coronado, Macro Policy Perspective. So first I want to say that I'm questioning my decision to share our data with Yuri, given the disrespect I'm detecting for professional forecasters. But nonetheless, I am sympathetic to his conclusions. I wanted to share another observation from our survey. So our survey is of more than 100 market participants every quarter. So very rationally attentive people. There's no inattentiveness here. They are, to Ben's point, putting their money where their mouth is. And one question that we've been asking since 2017, so through a range of inflation cycles, is do you believe that the current monetary policy tools are capable of generating a sustained period of 2% core PCE inflation within the next 2 years? So when we think about credibility, there's both the willingness and the ability to influence inflation, and is there a sacrifice ratio in periods of high inflation that's just, so high that the Fed will tolerate a miss for a sustained period? So it's kind of a supply side, you're getting at the supply side. So one thing that comes out of this, which Yuri notes and I'm very sympathetic to, is inflation expectations move around a lot in this very, very attuned group since 2017. The percent of people saying, yes, the toolkit is capable, went as low as 20% right before the pandemic because inflation was just sticky low and the Fed just couldn't get to 2% no matter what. And then it actually rebounded through the pandemic. As inflation went up, well, now we're away from the zero lower bound, and then the Fed actually followed through, and then the inflation came down. So that percent saying, yes, the toolkit is capable, went as high as 80%. Here's the cautionary tale. That has fallen back to 50% in Q1. So this, I think, ties together this, Governor Kugler and this idea that the recent experience may be influencing people's perceptions of how the economy works. So, yes, the Fed conquered the last bout, but now we've got another one. And, are they going to be willing to kill the economy? Are we in a world of supply shocks? So I do think that, I don't know that we go so far as to say inflation expectations are unanchored, but there's certainly more risks than we've seen, and I think the sequential inflation episodes are playing a role here.
Okay, let's take 3 more because we're getting out of time. Let's take a question from Governor Kugler, one in the back here, and then we'll end with Mike Kiley.
Thank you, Yuri, for a very provocative paper and very nice discussion, Mark. So I don't think this is about torturing the data. I think I agree that you can think about reverse causality and definitely omitted variables, and as you well said, these cost push shocks are not really unknown. They're actually quite well known, including not only commodity prices but just all sorts of import prices. I would also put in there supply shortages as measured by natural language processing models, which the staff here at the Fed has very nicely developed. So definitely worth including. I guess my key issue is about not only this measurement, right, and what your coefficients will be if you include all these other supply side shocks. And by the way, the supply shortages also includes demand. So that would take care of that as well. But it's also about interpretation. So, you for example, interpret this pre-pandemic period as having both unanchored and unattentive consumers and businesses. But if you think about it, former Chair Bernanke defined anchored to mean relatively insensitive to incoming information. Or former Chair Greenspan defined that as general price level, not affecting or altering business or household decisions. So one could just say, well, in fact, it's not that people are inattentive and inflation expectations are unanchored, but in fact, you could say they're anchored. So I guess there is an issue of interpretation there. And when it comes, I really appreciate your work, and I have cited it, and I appreciate the measurement of short-run inflation expectations. But there again, you have, I think, to be cautious, because we know inflation expectations, short-term inflation expectations, are certainly affected by short-term economic shocks, but these shocks could last more than a year. They could actually last maybe for a couple of years, right, and longer. So again, I suppose it's an issue of inflation, of your interpretation, if you have reasonably persistent shocks as well, and how you interpret that. Thank you.
Okay, question in the back.
Yeah. Hi, Angel Ubide from Citadel. Two questions for Yuri related to telling skill versus luck. So if households are the best predictors of inflation compared to professional forecasters or market participants, households are the ones that don't use any technology to forecast inflation, right? So is this another way of saying that inflation is impossible to forecast, as Stock and Watson have done many times, and they simply use an ERA 1 model, and they are luckier than all of us who try to devote hours and hours to forecast inflation using models? Mm-hmm. And the second one, inflation averaged 2% in the 2 decades before 2019, despite inflation expectations being an anchor as per your paper. So was the Fed lucky or just very good?
Okay, Michael.
Hi, Mike Kiley. Great paper, very interesting discussion. So on what I think it was very interesting, and I agree, inflation expectations may not be fully anchored, but thinking of whether the glass is half full or half empty, right? Under an optimal policy under discretion in a simple model like Mark's science of monetary policy, you're going to see persistent short-run movements in inflation if you have persistent supply shocks. And if you look across the historical episodes that Mark showed, right, I think you had a considerable degree of anchoring, whether in Michigan or others, during periods when you might view demand shocks as being more prominent, which is what would be true under optimal policy, and then less anchoring in short-run expectations during periods when supply shocks are more common, as again you would expect. And so I wonder if you've looked at that, in more detail to understand that better, or whether the data is just a little hard to do that with. I think secondarily, it would be interesting, given the importance of household expectations, to step outside of the price Phillips curve approach and think about a wage price system and the role of household expectations in wages, sort of building on Neil's observation, right? It's more than just, do we see it in union contracts, but have you done the same sort of experiments in wage dynamics, and what do you find in those exercises?
Okay, Yuri.
All right, many excellent questions and suggestions. Julia, you should not regret your choice. You did a lot for the progress of science, and many more people would like to use your data. But one thing which I agree with you is that when people start saying the Fed doesn't have tools to control inflation, it's a very troubling sign. And as a result, they should also create a lot more variation in their inflation expectations and more uncertainty. So we should be very careful about that. How torturing data, I was not exaggerating. In one central bank, which I'm not going to name, there is a survey of inflation expectations. It's a multiple choice, response question. The options are 1%, 2%, or 3%. Obviously, if you answer that survey, you're going to end up with very anchored inflation expectations. But that's not going to be the reality. We can see very big differences there. Now, the definition of insensitive expectations, it's a very interesting one. And this is related to an later question about, should we think about Fed as being successful when we had low inflation and everybody had more or less low numbers. In a way, it's a sign of success. If inflation is low and stable for a long time, people start paying attention to this. Right? This is, Greenspan definition that I don't want to have inflation to be, anywhere, in the decision making. But the flip side of this, if people are not paying attention to what the Fed is doing, again, that's a sign of success. It means when something is happening in the economy, they will not be aware of the fact that there could be some other policy decisions that may be important for them to think about. And so they may be changing their inflation expectations, not so much because of the Fed is telling them something, but because they see a different gas price and they start to think, different things. So ignorance versus attention versus anchoredness, I think it's a very delicate balance. But from what we see in the data, for example, when oil prices were high in 2007, mostly because of demand side factors, this was also the time when household surveys were reporting high inflation expectations. The question about skill versus luck, it's always a question if it's a selection effect or a treatment effect. It's very hard to answer this kind of questions. And why would we trust household surveys more than professionals? After all, what do these people know? But on the other hand, these people make many important decisions in their daily lives. They may be not perfectly informed, but there is a wisdom of the crowds, right? When you aggregate all this noisy inflation expectations and have an average of some type, you can actually see a lot of information in there. And going back to Mark's slides, professional forecasters made a terrible forecast error during the search. Households didn't, right? So in some sense, these guys know something that professional forecasters don't. Phillips curve with wage expectations. One thing we realized very quickly when we started to work with this subject is that we have not so much data that we can use in research. Wage expectations are collected only recently by the New York Fed. Most other surveys don't collect this information. And this is obviously a big barrier for anybody who is interested in these questions. So again, I want to encourage this group of people to fund more research on inflation expectations, wage expectations. I think we have a lot of questions to answer here.
All right, let's thank Yuri and Mark for terrific presentations. And thank you for the discussion.